I think we are talking about tax return. We have talked about personal income tax return. Under the tax return, we look at type of tax return. Personal income tax return, company income tax return, petroleum profit tax return. So in our last class, we look at type of tax return. We discussed personal income tax return in our last class, where we talk about payee return, where we talk about direct assessment. I think that is where we stop. So today, we are going to continue from where we stopped in our last class and look at company income tax return. Company income tax return. This company income tax return, they are the return that the company file. Every company, either limited company or public limited company or limited companies, they file company income tax return. And this company income tax return, the company file it as an evidence of compliance with tax at the end of the year, 6 months after the end of the financial year, after the end of the accounting year of every company, they must file their company income tax return. How does a company file company income tax return? If a company wants to file company income tax return, they will submit their audited financial statement and the computation of their company income tax and capital allowance. So for a new company, if it is a new company will file company income tax return within 18 months after the end, within 18 months from the date of commencement of business, or 6 months after the end of the first accounting year. But if it is an existing company, they will file company income tax return within 6 months after the end of the first accounting year. So that is company income tax return. Now, what are the contents of company income tax return? If a company wants to file company income tax return, what are the contents? One of the contents of company income tax return is duly completed self-assessment form. Duly completed self-assessment form. This is one of the contents of company income tax return. Duly completed self-assessment form. Number 2, audited financial statement. Audited financial statement, which comprises of statement of financial position, statement of comprehensive income, statement of changes in equity, statement of cash flows. Note on accounting policy. So this is the number 2 contents of company income tax return. Why number 3? Content of company income tax return. Number 3 is tax computation for the relevant years. Tax computation for the relevant years of assessment. The tax computation for the relevant year of assessment is going to include company income tax computation, tertiary education tax computation, police development levies. So aside from that, another content of company income tax return is capital allowance computation. Another content of company income tax return is capital allowance computation. Why another content is schedule of fees assets. Schedule of fees assets. Schedule of fees assets is another content of company income tax return. And another one is evidence of payment of taxes due. That means evidence of payment of company income tax, evidence of payment of tertiary education tax, evidence of payment of development. Hello, can you hear me?
Yes, sir. Good morning, sir.
Net is recharge. So about company income tax. However, a company business will a company business as you are here to commence business, but you don't company income tax. What you need to do. So I'm talking about pre-incorporation levy. For the pre-incorporation levy, if you are here to commence a business, but you are a company, you are incorporated, you will pay a pre-incorporation levy. For this pre-incorporation levy, 20,000 for the first year, while 25,000 for every subsequent year. That is on pre-incorporation levy. So now, what is the penalties for not filing company income tax return? If a company fails to file company income tax return, failure to file company income tax return, we attract a penalties of 25,000 for the first month and 5,000 for every subsequent month in which the failure continue. Failure to file company income tax, we attract a penalties of 25,000 for the first month and 5,000 for every subsequent month in which the failure continue. However, when a company file company income tax return, but they have not paid the company income tax, they will also pay penalties of 10% penalties plus interest at the commercial rates. So failure to file company income tax return attract a penalties of 25,000 for the first month and 5,000 for each subsequent month of failure. Plus another one, 10% of the amount of tax not filed or not paid, plus interest at prevailing commercial rates. That is the penalties for not filing company income tax return. We have looked at company income tax return. We have looked at content of company income tax return. We have looked at the timeline for filing company income tax return. So now we can go to value added tax return. How do we file value added tax return? Value added is a consumption tax. It's an indirect tax imposed on value added in the production of goods and services. And it is a multi-stage tax that is borne by the final consumer. Presently, the rate of value added tax is 7.5%. You understand? So value added tax return must be filed on a monthly basis. Every month, you must file value added tax return. Now, What is the timeline for filing value-added tax return? What is the timeline for filing value-added tax return? Value-added tax return must be filed not later than 21st day of the month following the month of transaction. Value-added tax return must be filed not later than 21st day of the month following the month of transaction. What that means is that your value-added tax return for the month of February must be filed not later than 21st of March. Let me repeat again. Your value-added tax return for the month of February must be filed not later than 31st of March. That is on value-added tax return. Now, what are the contents of value-added tax return? Who are the persons liable to file value-added tax return? We have the resident company, which is the Nigeria company. We also have the non-resident company. And government ministry, statutory bodies, and other agencies of government. They are to file value-added tax return. Companies operating in oil and gas too, they are also to file value-added tax return. Now, what are the contents of value-added tax return? What are the contents of value-added tax return? Number one content of value-added tax return: completed VAT return form 002. Completed VAT return form 002. That is number one content. While number two content is schedule of VAT collected, showing the name, the taxpayer identification number, and the amount of the VAT. Schedule of VAT collected, showing the name, the taxpayer identification number, and the amount of VAT. Another one, the total purchase value for the month. The total purchase value for the month. That is another content of value-added tax. Another content of value-added tax is the total value of goods exempted. The total value of goods exempted. While another content is total value of zero rated goods. Total value of zero rated goods. These are all the content of value-added tax. These are all the content of value-added tax. Now, what are the due dates for filing value-added tax? The due date for filing value-added tax is 21 days of the month following the month of transaction. 21 days of the month following the month of transaction. But in the case of VAT deducted at source, if VAT was deducted at source, what is the due date for filing that value-added tax? 14 days of the month following the month of transaction. 14 days of the month following the month of transaction, if the VAT was deducted at source. How was VAT deducted at source? Who's supposed to charge VAT? The seller of goods and services. But there are some companies, we call them direct VAT agents. If they went to market to go and buy goods from the seller. If the seller charge VAT, the VAT charged by the seller, they will not pay the seller. They will go and pay government direct. Those are the VAT deducted at source. The VAT deducted at source. Take for instance now, if you render service to any government ministry, or you render service to banks, or you render service to telecommunication company like MTN, if you include VAT in your invoice you send to them, they will not pay you the VAT. That VAT, they will go and remit it direct to government. That is VAT deducted at source. Hope my explanation is clear. Do we understand?
Yes, sir.
Now, failure to file VAT return is going to attract penalties. Failure to file VAT return is going to attract penalties. What is the penalty? Failure to file VAT return will attract penalties of 50,000 in the first month and 25,000 for each subsequent month in which the failure continues. So failure to file VAT return is going to attract penalties of 50,000 in the first month and 25,000 for each subsequent month in which the failure continues. Now, another type of return we need to look at, it is called petroleum profit tax return. It is called petroleum profit tax return. Which company file petroleum profit tax return? Which company file petroleum profit tax return? Company that engage in upstream petroleum operation. Company that engage in upstream petroleum operation. They are the one that file petroleum profit tax return. Company that engage in upstream petroleum operation. They are the one that file petroleum profit tax return. And how does those companies file petroleum profit tax return? This petroleum profit tax return is filed twice. It's filed based on estimated return. First, they file two types of petroleum profit tax return. One is called estimated return, which is filed at the beginning of the year, at least 2 months from the date of commencement of the accounting year. 2 months from the date in which the year starts. That means every company, every upstream petroleum company, they must file petroleum profit tax return at least not later than 28th of February. That is estimated return. In the estimated return, they will show the projected amount of petroleum profit tax that they will be paying every month. Petroleum company, they pay their tax every month. And the tax that they paid every month is called estimated tax. They will project that this 2026, so this is the profit we project to make, and this is the petroleum profit tax on the profit. They will now divide it by 12. They will now start paying it every month. That is estimated tax payment. And what are the content of estimated tax return?
Sorry, sir. I
First,
didn't really get your explanation for estimated tax. The network was breaking.
okay, I said petroleum company, if they want to file petroleum profit tax return, they file two types of return. First, estimated return. Second, actual return. Estimated return must be filed not later than 2 months from the beginning of the accounting year. In the estimated return, they will show the tax authority the estimated tax that they intend to pay in that particular year of assessment based on their estimated profit. And that estimated tax, they will divide it by 12. Once they divide it by 12, they will now start paying it every month. Now, what are the content of this estimated tax return? First, statement of estimated income and expenses for the period. Statement of estimated income and expenses for the period. Another one, statement of estimated adjusted profit and loss. Statement of estimated adjusted profit and loss. Why estimated tax and capital allowance computation for the period. Estimated tax and capital allowance computation for the period. And the last content of estimated tax return is computation of estimated monthly tax payments. This is the first return filed by company engaged in upstream petroleum operation. That is estimated return. In the case of actual return is called annual return. This actual return or annual return, it is filed after the end of the accounting year. It is filed after the end of the accounting year. 5 months after the end of the accounting year, every upstream petroleum company must file actual return or annual return. They must file it 5 months after the end of the accounting year. The purpose of annual return that they are filing is for them to show the tax authority the actual position of their profit that they make. Once they show the actual position of their profit, they compute the tax based on the actual profit. They now remove the tax they are paid based on what? They will remove the tax that they have paid based on what? Based on estimated tax. The balance that they need to pay is going to be the 13 installments. The balance that they need to pay is going to be the 13 installments. Assuming they have paid 20 million based on estimated tax, and when they are doing their annual return, they discover that they need to pay petroleum profit tax of 25 million. They will remove the 20 million. They will now pay the balance of 5 million. That balance of 5 million is the 13 installments. That one will be paid 5 months after the end of the year. Now, what are the contents?
Sir, is it possible? Hello, sir.
I can
Sir,
hear
is
you.
it possible for the annual return to be less than their estimated tax?
Yes, it's possible. It's possible.
So how are we going to treat such?
That means there are going to be tax refund. There are going to be a tax refund. There will be a tax refund. So there will be a tax refund. Or the balance, they can carry it forward to the next year, next financial year, and they use it to reduce their tax in the next financial year. Do you understand?
Yes, sir.
Now, content of annual return. Audited financial statement for the year. Statement showing the qualified capital expenditure incurred during the period. Computation of chargeable profit and loss for the period. Computation of chargeable profit and loss for the period. A statement of other sum deductible, the liability which is incurred for the period. Computation of capital allowance for the period. Computation of actual tax payable for the period. So these are the content of annual tax return. Now, what is the penalty for not filing annual tax return? If a company fails to file annual tax return, they are going to pay. If a petroleum company fails to file annual tax return, they will pay a penalty of 10 million naira in the first instance and 2 million naira for each day in which the failure continues. If a company fails to file annual tax return based on petroleum profit tax, they will pay a penalty of 10 million naira in the first instance and 2 million for each day in which the failure continues. Apart from that, late payment of petroleum profit tax will also attract a penalty of 5% of the amount of tax not paid. Late payment of petroleum profit tax will also attract the penalties of 5% of the amount of tax not paid. Do we understand?
Yes, sir.
So that is what we need to know on tax return. That is what we need to know on tax return. So do we have any question on this?
Sir,
Yes.
before your line went off, you were trying to say something. I didn't really get you. I didn't get what you were saying. When you said about for about company, commencement of a new company,
Okay, I'm
something
talking of pre-operation levy. Companies that are yet to commence a business, but they have incorporated, they will not file company income tax return. They will either be paying every year, they will be paying pre-operational levy while submitting their statement of affairs. And first year, for every company, if they want to pay pre-operational levy, 20,000 in the first year, 25,000 for each subsequent year. If you are a company, you are yet to commence business, but you have incorporated, that means they have given you certificate of incorporation, but you are yet to commence a business. You will pay at the end of every year. You will not be filing company income tax return since you are yet to commence business. You are not doing business. But every year, the law requires that you should be paying pre-operation levy. That pre-operation levy for the first time, for the first year, being a new company, you will pay 20,000. But for each subsequent year, you will now pay 25,000. Hope this is clear.
Yes, sir. Sir, like for how many years will you be paying that when the company
You
is
continue
open?
to pay it until you commence business. Take for instance now, I registered my company. I was given certificate of incorporation. I have my TIN number, but I'm yet to commence business. Every year, I have an obligation to be paying pre-operational levies to the FRS. Until I commence, once I commence business, I will stop paying pre-operational levy. I will be paying company income tax and education tax. However, in the new tax law, there is no more pre-operational levy in the new tax law. Pre-operational levy has been deleted in the new tax law. No more pre-operational levy. So if you are a company, if you are not doing business, you don't need to pay any tax in the new tax law. You don't need to pay pre-operational levy if you are yet to commence business. Do we understand?
Yes, sir.
So that is what we have on tax return. Last week, we talked about personal income tax return. This week, we talk about company income tax return, value-added tax return, and petroleum profit tax return. So the next area we are going to now, the next area is the area of tax assessment. Is the area of tax assessment. Tax assessment and assessment procedure. Tax assessment and assessment procedure. What do you understand by tax assessment? Tax assessment is the process by which the relevant tax authority determines the amount of tax payable by a taxpayer. The process of evaluating the income, the profit, the transaction of the taxpayer with the purpose of computing their tax liability. It is called tax what? Assessment. Do we understand? The process by which the relevant tax authority determines the amount of tax payable by a taxpayer. It is called tax assessment. Now, on these tax assessments, what are the type of assessment we have? What are the type of assessment we have? We have different type of tax assessments. We have different type of tax assessments. Number one, self-assessment. Number one is what? Self-assessment. While number two is government assessment. Number three, best of judgment assessment. We have another assessment called turnover assessment. We have provisional assessment. We have assessment based on dividend and so on like that. So now, let's go and explain them one by one. First, we start from self-assessment. What do you understand by self-assessment? Self-assessment. Self-assessment simply means a tax assessment process where taxpayer compute their own tax liability by themselves. Taxpayer, they compute their tax liability by themselves without waiting for tax authority to come and compute their tax. Self-assessment means a situation where the taxpayer will be the one to determine the amount of tax that they will pay. Taxpayer is the one that will compute his company income tax. Taxpayer is the one that will compute his personal income tax. Taxpayer is the one that will compute his education tax. And he will now go and pay the money to the tax authority. They will not wait for tax authority to come and help them compute their tax. They will compute it by themselves. That is self-assessment. Most of the return that we file, either personal income tax return, value-added tax return, company income tax return, they are petroleum profit tax return. All those returns that we just explained finish. They are filed based on self-assessment. It is the taxpayer that will compute the capital allowance by themselves, compute the company income tax by themselves, compute the value-added tax by themselves, compute the education tax, compute the personal income tax. They don't need to wait for tax authority because tax authority cannot be going to every company at the end of the year by saying, give us your account, let us help you to compute your tax. There is no time. Look at the number of companies we have. How will tax authority be going around, be asking company for their record to be? So tax authority now said, taxpayer, I trust you. Based on trust, be computing your own tax by yourself and be paying the tax. But at the end of the year, we are going to checkmate either for certain number of years, maybe 5 years, we are going to add all your return you have filed based on self-assessment together and go and conduct tax audit on them to determine whether that your self-assessment you file is correct or wrong, to determine whether you are going to have additional assessments. So that is what self-assessment means. What are the benefits of self-assessment? Benefit of self-assessment. It enhances the pace of tax collection, and there is no need to wait for the computation or processing or raising of assessment. So it enhances the pace of tax collection. Another benefit, it is democratic in nature because it allows taxpayers to participate in assessment. It is democratic in nature because it allows taxpayers to participate in assessment. Another one, it gives taxpayer a sense of belonging and responsibility. It gives taxpayer a sense of belonging and responsibility. It reduces cost of collection, cost of tax collection by shifting the cost of tax collection to the taxpayer. It saves the cost of tax authority, cost of going around to every country by tax authority, asking them for their account to help them to complete their tax. It reduces it. It saves their time. Cost of printing. So it reduces. Another one, the taxpayer is entitled to 1% bonus of the tax payable. Taxpayer is entitled to 1% bonus of the tax payable. Taxpayer is entitled to 1% bonus of the tax payable. So these are the benefits of self-assessment. What are the limitations of self-assessment? What are the limitations of self-assessment? What are the limitations? Limitation of self-assessment, one of the limitations is that there may be a lower compliance rate because as a result of high illiteracy level in the country. If you are asking taxpayers to complete their tax by themselves, the compliance rate will be low because most of the taxpayers don't know how to complete their tax by themselves and they don't want to spend money to engage tax consultants. Most especially those in the informal sector, one-man business, sole trader, artisan, these people doing their own business, you understand? They will not know how to compute their tax by themselves now, and you say they should be computing tax based on self-assessment. So, and some of them may not have money to engage tax consultants. So, there will be low rates. Another limitation is there could be high level of understatement of tax liability due to high degree of desire to evade tax in Nigeria. Even the one that is computed by themselves by a company, most of the company, the return that they file based on self-assessment, they normally understate their what? They will understate their what? In order to reduce their tax. They will understate their income and they will overstate their expenses. Most of the company income tax return filed by a company. If a company make a turnover of 300 million in a year, if a company want to file return to the tax authority, they will say they make a turnover of 200 million or 150 million. They will not disclose their true turnover, their actual turnover. They will not disclose it in order to evade tax. Because when they understate their turnover, their profit will reduce and the tax will also reduce. Do we understand? Do we understand? Hello?
Yes, sir. Yes, sir.
Okay. So these are the limitations of self-assessment return. Now, what are the steps for self-assessment return? If a company or individual, they want to file self-assessment return, they want to file their return based on self-assessment, what are the steps that they need to follow? First, the taxpayer will collect self-assessment form. The taxpayer, they will collect self-assessment form. The taxpayer will collect self-assessment form. Why? From the tax office. The taxpayer, they will complete the self-assessment form showing their income for the relevant year of assessment, showing their expenses, showing their profits. The taxpayer will then pay the tax based on the amount of tax that they fill in the self-assessment form. After the assessment is done and payment is made, tax authority, they will now come and review the return filed by self-assessment. They will review it. If tax authority want to review the return filed by self-assessment, that means they want to do tax audit on the company. They want to do what? Tax audit on the company. You know, we have two type of tax audits: desk audit and field audit. Desk audit, it is the tax audit where the tax authority review the book and record of the taxpayer in the premises of the tax authority, in the office of the tax authority. But in the case of field audit, tax authority review the book and record of the taxpayer in the office of the taxpayer, in the premises of the taxpayer. Field audit is more elaborated, more wider in scope than desk audits. Do we understand? Do we understand?
Yes, sir.
Yes, sir.
So that is what we need to know on self-assessment. Another type of assessment we want to look at now is called government assessment. Another type of assessment we want to look at is called government assessment. What is government assessment? It is an assessment raised by the tax authority on the taxpayer. An assessment raised by the tax authority on the taxpayer based on the account submitted by the taxpayer to the tax authority. So that is government assessment. In government assessment, tax authority will ask the taxpayer, give us your account. From the account, they will now compute the tax that they will pay. Do you understand? They will not ask them to compute their tax by themselves. it is the tax authority that will compute the tax that they will pay based on the account submitted to them by the taxpayer. That is government assessment. Another type of assessment we have is called BOJ. Another type of assessment we have is what? BOJ. Most of the questions in our level normally come from BOJ. When they want to ask questions on tax assessment, they normally ask either self-assessment or VOJ. They can ask, what is self-assessment? What is best of judgment? Or what are the content of best of judgment? So if you have started reviewing past questions, or if you review past questions very well, you will see a lot of questions coming from self-assessment, a lot of questions coming from BOJ, best of judgments. So another type of assessment we have is called best of judgment assessment. What is best of judgment assessment? An assessment raised by the tax authority when the taxpayer failed to file their return within the stipulated time required by the law. Taxpayer, tax authority give them privilege to file their return based on self-assessment. What is the due date for filing company income tax return? Company income tax return. What is the due date for filing it?
June, 6 months after.
6 months after the end of the accounting year. Do you understand? And when you file your company income tax return within 6 months after the end of the accounting year, that means you are filing the return based on self-assessment. But if you fail to file it within that 6 months, tax authority will not have option than to raise best of judgment assessment on you. If you fail to file your return within that 6 months after the end of the accounting year, tax authority will not have option than to raise best of judgment return on you, best of judgment assessment on you. So it is a process where tax authority assess taxpayer if they fail to file return within the stipulated time required by the law. Best of judgment assessment, tax authority will raise best of judgment on the taxpayer based on the best knowledge, based on the knowledge, based on the knowledge, based on the knowledge, best of their knowledge. Based on the best of their knowledge. Because taxpayer has failed to provide information. What do you want? Okay. So the information available, taxpayer failed to provide it. Tax authority don't have option than to use best of knowledge to get that information. In best of judgment assessment, tax authority will assume your income based on your standard of living. If you are a company, based on your location, they will say this is your income you make in this year. This is the profit you make. Since you don't provide information, they will not ask you to pay tax based on that. Best of judgment assessment is mostly common for individual personal income tax. When individuals fail to file return, most especially self-employed person, when they fail to file their return as at 31st of March, tax authority will raise best of judgment assessment for them. This best of judgment assessment is going to be raised on them based on they will look at the standard of living of that taxpayer. Is that taxpayer driving a car? They will go and do background check on the taxpayer. Which school the taxpayer children is going? Does the taxpayer staying in a high-brow area in Lagos? Maybe he's staying in Lekki, Banana Island. Somebody staying in Lekki and Banana Island or Ikoyi. You should not expect them to pay the minimum tax now. They should pay the heavy tax. So when they fail to file information, when tax authority asks, give us your bank statement, you fail to provide. Give us your statement of income and expenses. You fail to, they will not have option than to raise base of judgment assessment on you. They will assume this is your income. This is the tax you must pay. Now, what are the conditions for base of judgment assessment? What are the conditions for base of judgment assessment? When the taxpayer has failed to file his financial statement and return, taxpayer, they fail to file their financial statement and return within the timeline, within the due date. When taxpayer file their financial statement, but they fail to provide to the tax authority information on that financial statement, or when the tax authority are in opinion that the financial statement filed by the taxpayer is not correct, base of judgment assessment will be raised on the taxpayer. So another type of assessment we have, it is called turnover assessment. Turnover assessment means when a company is assessed to tax based on the percentage of their turnover. Turnover assessment is common to a company. A company, tax authority assess a company to tax based on the percentage of their turnover. For turnover assessment, Section 30 of Company Income Tax Act said if a company does not have accessible profit or adjusted profit, but we know their turnover, we only know their turnover, we don't know the adjusted profit, we don't know their expenses. The law provided that there should be assessed on turnover. So one of the conditions where a company will be assessed on turnover is when there is no accessible profit, or when the accessible profit is lower than the expected amount based on the opinion of tax authority. One of the conditions where a company will be assessed on turnover is where there is no accessible profit, or where the accessible profit is lower than the expected amount based on the opinion of the tax authority, or when the amount stated, the amount of the accessible profit cannot be readily ascertained. When the amount of accessible profit cannot be readily ascertained. So these are the conditions for filing turnover assessment. In turnover assessment, the company will pay their company income tax based on percentage of the turnover. In the new tax law, turnover assessment is called effective tax rate. Who can tell me effective tax rate under company income tax in the new tax law? What is the effective tax rate? What is the rate? What is the rate of effective tax under the new tax law? Who can tell me?
30%.
Oh, 30%. No. Though it's none of your business. It's 15%. 15% of your turnover. So now, another type of assessment we need to look at is additional assessment. Additional what? Assessment. What is additional assessment? Additional assessment is an assessment that arises as a result of tax audit and investigation. This additional assessment is an assessment raised by the tax authority arising from tax audits and investigation. An assessment raised by the tax authority on the taxpayer arising from tax audit and investigation. When tax authority conduct tax audit, when they want to checkmate the self-assessment return filed by the taxpayer, whether it's correct or wrong, from the self-assessment return, there is no how tax authority will review your self-assessment return that they will not determine additional assessment. They will discover additional assessment. So that additional tax you pay from the review of your self-assessment return by the tax authority, it is called additional assessment. Mostly, tax authority will conduct tax audit on either 4 years, 5 years, or 6 years financial statement. The return you have filed based on self-assessment for the last 4 years, they will conduct tax audit on it to determine whether they will get additional assessment. So another type of assessment we want to look at is called provisional assessment. Another type of assessment we want to look at is called provision.
Sir, if additional assessment is found, will that call for penalty for that company?
Yes, penalties and interest. Penalties and what? Interest.
An interest.
Penalties and interests. Now, provisional assessment. What is provisional assessment? Provisional assessment is where the taxpayer want to collect tax clearance certificate. Taxpayer want to collect a tax clearance certificate, but they have not finished preparing their financial statement and they need to pay tax. They can pay tax based on the amount of tax that they paid in the preceding year. Take for instance, I want to pay tax for 2025 year of accounting year end. I want to pay it. Tax authority can say, since your audited account for year 2025 is yet to be ready, go and pay the amount you pay in 2024 audited account as tax first. So provisional assessment is made when taxpayer have not delivered return to the tax authority. And it is the opinion that such company is liable to tax. So tax authority will now determine the amount of total profit, and the tax payable that the taxpayer will pay based on the amount of tax that they have paid in the preceding year. the amount of tax that they have paid in the preceding year. Take, for instance, the deadline for filing company income tax return is 6 months. By June, your audited account is yet to be ready because of one reason or the other. Maybe the accountant is late or something happened. So your audited account is, so you can write to tax authority, my audited account cannot be possible by end of June, but please allow me to pay company income tax based on what? Provisional assessment, based on the amount of tax I've paid in the preceding year. That is immediate preceding year. The amount of tax I've paid in the year 2024. Let me pay the company income tax I've paid in the year 2024 for this year 2025. After my audited account is now ready, once I know my true position of tax, I will now pay the additional balance. That is what provisional assessment means. So for the sake of time, let's look at another one called assessment based on dividend. Assessment based on dividend. Assessment based on dividend. How does that possible? When company declare dividend, company pay company income tax based on their total profit. In a particular year, the total profit of the company is 200 million. Do you understand? In that year, that company now declared dividend of 300 million. If tax authority want to compute their company income tax, they will not compute it on total profits. They will compute it on dividend. That means when you declare dividend more than your total profits, you are going to pay company income tax based on dividends. So that is called assessment based on dividend or dividend assessment. Assessment based on dividend means a situation where company pay their company income tax based on the amount of dividend declared to the shareholders. What are the conditions for paying your company income tax based on dividend? Number one, when there is no accessible profit, you don't have a total profit in that year. That means you have a loss. You have a loss. You now declare dividend. Where do you see the profit that you declare the dividend? Since you are showing a loss, you don't want to pay company income tax and you declare dividend, tax authority will say you should pay company income tax based on the amount of dividend you declare to the shareholder. Second condition, when the amount, the accessible profit, the amount of your total profit or your accessible profit is less than the dividend paid or your proposed dividend. In such instance too, you will be paid, you'll be asked to pay your company income tax based on dividend. However, what are the exemptions? Financial 2019 made to dividend assessment. What are the exemptions? Financial 2019 made to dividend assessment. They said if a company declare dividend from retained earning, if you can provide evidence that that dividend that you paid to your shareholder is from your retained earning or is from your reserve, such dividend will not be taxed based on company income tax. if you can claim that the dividend that you pay to the shareholder is from retained earning, that dividend will not be taxed. Secondly, dividend paid out by tax-exempt income. If you can prove to the tax authority that the income that you pay the dividend from in the current year of assessment is from activity that is not subjected to tax, that is not subjected to income tax, in such instance too, you will not be assessed based on dividend. So those are the conditions where you will not be assessed. If the dividend is also declared by real estate investment companies too, if that company that declared the dividend from their profit is real estate investment company, such dividend too will not be taxed. But if you are not part of this, maybe the dividend is not paid from retained earnings, or the dividend is not paid from tax-exempt activities, or the dividend is not declared by a real estate company. If you declare the dividend from your actual profit and your total profit you show to the tax authority is now less than the actual profit, in that regard, you will be assessed to tax based on dividend. Is this clear enough? Hello? Is this clear enough?
It's clear, sir.
Okay.
Yes, sir.
Another type of assessment we need to look at, minimum tax assessment. Minimum tax assessment has been removed in the new tax law. No more minimum tax again in the new tax law. Minimum tax assessment is an assessment raised by the tax authority when a company declares loss in their financial statement. Company that declare loss in their financial statements. A company declare loss in their financial statement, they will be assessed to tax based on minimum tax. So minimum tax will arise when a company declares loss in their financial statement. By declaring the loss, they think that they will not pay tax. They will be assessed to tax based on minimum tax. When you declare loss in your financial statement, as a company, you will pay minimum tax. Your assessment will be based on minimum tax. What is the rate of minimum tax? The rate of minimum tax is 0.5% of turnover. 0.5% of turnover, less frank investment income. 0.5% of turnover, less frank investment income. That is the rate of minimum tax. That means in a year that any company, if they declare loss in every year, in any year, they will be assessed to tax based on minimum tax. However, Finance Act 2020 said minimum tax rate should be reduced from 2020 and 2021 because of COVID. The minimum tax rate from 2020 and 2021 is 0.25%. But after 2020 and 2021, the minimum tax rate should be the normal rate. What is the normal rate of minimum tax rate? What is the normal rate of minimum tax
0.5%.
rate? 0.5%. So while you are computing minimum tax, if the year end is 2020, what rate are you going to use for minimum tax?
0.5%.
If the year end is 2020, what rate are you going to use?
0.25.
0.25. If the year end is 2021, what rate?
0.25.
If the year end is 2023, what rate?
0.5.
0.5. Year end 2025.
0.5.
What rate? 0.5. Do you understand?
So I don't understand though.
I said because of COVID-19, Financial 2020, which was issued in the year 2020, said, companies don't do business. Company, they have problem in most of the company. They have challenges in 2020 and 2021. Because of what? Because of what? Impact of what? COVID-19. Company cannot do business. Most of the company, they locked down in the year 2020. That effect will affect them in 2021. And when they bring the rule of minimum tax was introduced by Finance Act 2019. But Finance Act 2020 now said, because of COVID-19, for 2 years, minimum tax rate should be reduced to 0.25%. What are the 2 years? Starting from 1st of January 2020 to 31st of December what?
2021.
2021.
That means within this period, the rate of minimum tax we must use is half of the normal rate. What is the half of the normal rate?
0.25.
0.25. After this period, we go back to the normal rate of minimum tax rate. What is the normal rate?
0.5%.
0.5%. Minimum tax is computed on turnover. Minimum tax is computed on turnover. So it's based on their turnover. Turnover you make in a year as your company, 0.5% of it, less frank investment income. That will be your minimum tax amount. And the condition for paying minimum tax is when company report a loss. When a company report a loss, when you are reporting a loss in your financial statements, and that loss, or when the amount of your minimum tax is higher than the actual tax computation. However, there are some exemptions for minimum tax. There are some companies, they are exempted from payment of minimum tax. Even when they make a loss, they will not pay minimum tax. There are some companies, they are exempted from minimum tax. Even when they make a loss, they will not pay minimum tax. What are the companies that are exempted from minimum tax? A small company that has a turnover of less than what?
25 million.
25 million. If a small company that has a turnover of less than 25 million make a loss, they will not pay minimum tax. Even if they make a profit, will a small company pay company income tax?
No.
If your turnover is
No,
less than
sir.
25 million, are you going to pay company income tax?
No, sir. That is exempted
No.
from company.
You are exempted from company income tax. Likewise, too, you are exempted from minimum tax as a small company. A company engaged in agricultural trade or business, a company that engaged in agricultural trade or business too, is exempted from minimum tax. If you are if you deal with you are into agricultural business, maybe you are rearing animal or you are planting a crops. If you make a loss from your business, you will not pay minimum tax. All companies in their first 4 years of operation, every new company in their first 4 years of operation, they are exempted from minimum tax. All companies in their first 4 years of operation, they are exempted from minimum tax. Do we understand?
Yes, sir.
For individual or employee or individual earning less than minimum wage, any minimum wage or below, they will not pay minimum tax. We should have it in mind. The new tax law, there is no more minimum tax in the new tax law. So for individual, if you are individual or you are employee, personal income tax, their own minimum tax is 1% of your gross income. But an individual earning minimum wage or below will not pay minimum tax. That means if your salary is 70,000 or below, you will not pay tax. You will not pay personal income tax. You will not pay minimum tax. That is what that law is saying. Now, the next one we want to look at is final and conclusive assessment. Final and conclusive assessment. An assessment raised on a company is stated to be final and conclusive when no valid objection and appeal has been lodged against the amount of total profit assessed within the time frame. When the amount of total profit has been agreed by the taxpayer after its objection has been determined by FRS. When the amount of total profit has been determined on appeal, that is final and conclusive assessment. Assessment is deemed to be final and conclusive when no valid objection or appeal has been raised, when the amount of total profit has been agreed by the taxpayer after its objection has been determined by the FRS, or number 3, when the amount of total profit has been determined on appeal. Now, the next area we are going to is assessment procedure. Assessment procedure. How do we assess company to tax? What are the procedure? This assessment procedure, we want to explain the flow chart of tax audit process. This assessment procedure refers to formal process of evaluating and determining tax liability of individual, business, organization under the tax law. This process is carried out by FRS or State Internal Revenue Service. This assessment procedure normally arises as a result of tax audits. If tax authority come to do tax audit in your company, After the tax audit, first thing that they will give you is notice of what? Notice of assessment. In the notice of assessment, what is notice of assessment? It's an official document or letter written by the tax authority, either FRS or State Internal Revenue Service, informing the taxpayer the amount of tax that they will pay for specific period of time. When a tax authority come to review your record, they come to do tax audit, they come and review your record. After they review your record, based on your return you file based on self-assessment, they now review your record. If tax authority want to do tax audit on your record, they will do it like on 4 years account, 5 years account, 6 years account. After reviewing your record, they now discover that you need to pay additional assessment. If they want to write a letter to you on that additional assessment, they will write you a letter called notice of what? Notice of assessment. By telling you the additional tax you need to pay, including the penalties. So number one assessment procedure that we have is called what? Notice of what? Notice of assessment. When you are talking of assessment procedure, number one under the assessment procedure is notice of what? Assessment. Now, what are the content of notice of assessment? Number one, taxpayer name, the name of the company or the name of the individual. That is number one content. After that, taxpayer identification number. Taxpayer what? Identification number. The address of the taxpayer is another content of notice of assessment. The assessed amount, the amount assessed to tax. These are the content of notice of assessment. The year of assessment, the year that the notice of assessment covers. All these are the content of notice of assessment. After notice of assessment, number two is notice of objection. Notice of objection. After notice of assessment, when a taxpayer receives notice of assessment, taxpayer can pay the assessment, or he can do what? He has a right either to pay or to do what? To object. I don't know. Notice of objection. When a taxpayer refuses, disagree with the notice of assessment, taxpayer will write a letter to the tax authority. That letter written by the taxpayer to the tax authority, that letter is called notice of what? Objection. The letter written by the tax authority, by the taxpayer to the tax authority, to dissatisfy the notice of assessment. That letter is called notice of objection. The letter written by the taxpayer to the tax authority to decertify the notice of assessment. That letter is called notice of objection. This notice of objection must be written to taxpayer within 30 days from the date of receiving notice of assessment. If taxpayer don't write notice of objection to the tax authority within 30 days of receiving the notice of assessment, if they don't write the notice of objection, that means that notice of assessment is deemed to be final and what? Conclusive. If you receive notice of assessment from the tax authority, you must, if you don't agree with the amount of tax that they say you should pay from the notice of assessment, you must object it within 30 days of receiving the notice of assessment. If you fail to object it within 30 days, that assessment is deemed to be final and what? Conclusive. Do we understand? Do we understand?
Yes, sir.
Now, when you want to write notice of objection, what are the grounds for valid objection? What are the contents you must state in your notice of objection? Or if for your notice of objection to be valid, what are the points you must state in that notice of objection? For the notice of objection to be valid, what are the points you must state in the notice of objection? Number one, state the precise ground of the objection. The reason why you don't agree with the amount of tax that they say you should pay, you must state the precise ground of the objection. Number two, for your objection to be valid, the objection must be submitted within 30 days of what? Of receiving notice of what? Notice of assessment. Number three, that your objection must be made in written and addressed to the chairman of Federal Inland Revenue Service or State Internal Revenue Service. Number three condition or ground for valid objection. The objection must be made in written and addressed to the chairman of Federal Inland Revenue Service or State Internal Revenue Service. These are the grounds for valid objection. You may be asked, some questions too normally come from notice of objection. They ask you what are the grounds for valid objection. State the precise ground of the objection. The objection must be submitted within 30 days of receiving the notice of assessment. The notice of objection must be made in written and addressed to the chairman of either Federal Inland Revenue Service or State Internal Revenue Service. After notice of objection, the next assessment procedure, that is number three, is called notice of amendment or refusal to amend. NOA or NRA. NOA or NRA. Notice of amendment or refusal to amend is a letter written by who? Tax authority to the taxpayer. If it is notice of amendment, the letter will be written by the tax authority to the taxpayer based on the notice of objection that they receive and stating that they have amended the notice of assessment based on the evidence provided by the taxpayer in the notice of objection. You know, if you want to write notice of objection to the tax authority, you must attach some evidence to it, like your company bank statement, like your sales invoice, your third-party evidence, your fees access schedule. You must attach some evidence to notice of your objection. No? If tax authority now receive your notice of objection, they will review it. If they now review your notice of objection, if they are satisfied with your argument in your notice of objection, they will amend the notice of assessment. That means they will reduce the tax liability state in the notice of assessment. When they amend the notice of assessment, the assessment rates in the notice of assessment, the liability rates in the, when they amend it, they will write you a letter called notice of amendment. This notice of amendment is a letter written by the tax authority to taxpayer stating that they have received their notice of objection and they have amended the notice of assessment, or they have revised the notice of assessment based on the evidence provided in the notice of what? Objection. Second thing that may happen, when a tax authority receives your notice of objection, if your evidence you provided, your ground of objection is not valid, you don't have supporting document, you don't provide sufficient evidence, they will write you a letter. What is the second letter that they can write you?
Refusal to amend.
Notice of refusal to amend. They will state that though they have received your notice of objection, but the evidence you provided in this notice of objection does not hold ground. It does not substantiate. It does not in line with the provision of the tax law. Therefore, their earlier position based on the notice of assessment still remains the same. That means they have refused to amend the assessment. Number 4 step, number 4 assessment procedure is notice of appeal. Notice of what? Appeal. This notice of appeal is written by who? Taxpayer. And it must be written within 30 days of receiving either notice of amendment or notice of refusal to amend. Notice of appeal is a letter written by the taxpayer based on the letter received from the tax authority based on notice of refusal to amend. Taxpayer will now write another letter, notice of appeal. This notice of appeal, taxpayer will address it to who? Tax Appeal Tribunal. Tax Appeal Tribunal, they are the ones that settle disputes between taxpayer and tax authority. They are the first court process in tax disputes. If you want to go to court in tax, you have to first of all table your case to Tax Appeal Tribunal. From Tax Appeal Tribunal, you go to Federal High Court. From Federal High Court, you go to where? Court of what? Appeal. From Court of Appeal, you go to where?
Supreme Court. Supreme Court.
Supreme Court. From Supreme Court, you go to where?
Yes, sir, can hear you now, sir.
So, notice of appeal. It is a letter written by the taxpayer to Tax Appeal Tribunal based on the notice of refusal to amend received from the tax authority. While you write notice of appeal, you address it to Tax Appeal Tribunal, asking Tax Appeal Tribunal to come and help you resolve the dispute. By writing to Tax Appeal Tribunal, that means you are taking the tax authority to court. Tax Appeal Tribunal, they are just like a court. So, when you write notice of appeal to Tax Appeal Tribunal, this notice of appeal, you must write it within 30 days of receiving notice of refusal to amend. Notice of appeal is a letter written by the taxpayer to tax appeal tribunal based on the notice of refusal to amend received from the tax authority, asking tax appeal tribunal to review the case, to review the issues. Now, once you write notice of appeal to tax appeal tribunal, that means you have taken tax authority to court. Now, the tax authority, tax appeal tribunal, will now invite you and the tax authority. So what are the contents of notice of appeal? The name and address of the taxpayer. The name and address of the taxpayer. Content of notice of appeal. The name and address of the taxpayer will be stated in the content of notice of appeal. The name and address of the taxpayer. The official number of the assessment and the year of the assessment. The official number of the assessment and the year of the assessment. The amount of tax charged by such assessment. The amount of tax charged by such assessment. The amount of total profit upon which tax was charged. The amount of total profit upon which tax was charged. The date on which the appellant was served notice of refusal to amend. The precise ground of the appeal. The reason why you want to take them to the appeal, tax appeal tribunal. So you must state that. These are the content of notice of appeal. You can be asked, what are the content of notice of appeal? Please take note of that. You can be asked, what are the content of notice of appeal? Please take note of that. The name and address of the taxpayer, the official number of the assessment and the year of assessment which was made, the amount of tax charged by such assessment, the amount of total profit upon which tax was charged as appearing in the notice of assessment, the date on which the appellant was served notice of refusal to amend, the precise grounds of the appeal, the address for serve of any notice or document to be given to the appellant by the tax appeal tribunal. Now, once tax appeal tribunal receive your notice of appeal, they will invite tax authority. They will fix a date for hearing. Tax appeal tribunal will fix a date for what? Hearing. They will now invite you and the tax authority. You come with your evidence. You can come with your lawyer. Tax authority too will come with their evidence and their lawyer. At the end of the day, tax appeal tribunal will notify the tax authority that they must appear. Somebody bring case against them. You understand that? One taxpayer brought a case against them, and they want them to appear in the tribunal so date. They will fix a date for hearing. Once they fix a date for hearing, they will invite you, invite the tax authority, ask for evidence from you, ask for evidence from tax authority. Ladies and gentlemen, TAT, Tax Appeal Tribunal, we have them in the 6 geopolitical zone: Southwest Tax Appeal Tribunal, South-South, Southeast, Northwest, Northeast, North Central. Every 6 geopolitical zone have their Tax Appeal Tribunal. This Tax Appeal Tribunal is headed by the chairman. We have chairman of Tax Appeal Tribunal. Every zone have their own chairman. And the chairman of the Tax Appeal Tribunal must be a legal practitioner with nothing less than 15 years in tax litigation. For an appeal, for Tax Appeal Tribunal For them to form a quorum, at least 3 members must be available. We have member of tax appeal tribunal. I don't know their number now. Maybe they are 12 in number or 7 in number. But if they want to sit to hear a case between taxpayer and the tax authority, at least 3 members of the tribunal must be available to form a quorum. So even in the Finance Act 2020, tax appeal tribunal can be here. They can fix a hearing, virtual hearing. That means if they want to hear a case between tax authority and taxpayer, it's not necessary they conduct the hearing in their office. Because of COVID-19, Finance Act, Section 57 of Finance Act, allow them to do a remote meeting, remote hearing. That means virtual hearing, online, without coming to their office. At the end of the day, my people, tax appeal tribunal will hear the case between the tax authority and the taxpayer. They will make their judgments. Once they make their judgments, if tax authority is not satisfied with their judgment, or taxpayer is not satisfied with their judgment, any of the party, any of the 2 parties, if the appellant or the, what do you call the second one, the defendant, if either the appellant or defendant is not satisfied with the judgment, 2 of the parties have a right to proceed further. If the judgment is in favor of tax authority and the taxpayer is not satisfied, taxpayer, you have a right to proceed further. That means you can take the case further from tax appeal. You take it to where? Federal High Court. You take it to Federal what? High Court. For Federal High Court, if tax authority is not satisfied with the judgment of tax appeal tribunal too, they can take the case to Federal High Court. Now, what are the conditions for you to appeal a case before Federal High Court? A tax case before a Federal High Court. Number 1, the amount involved must not less than 400 naira. This law is low. They're supposed to amend this. The amount involved must not less than 400 naira. Is it because of 400 naira I will now be taking tax authority to court? This is outdated. They're supposed to have amended this. Maybe like 400 million naira or 40 million naira. Time value of money. The appeal must be on point of law. The notice of appeal given to tax appeal tribunal within 30 days after the date of judgment of the tax appeal tribunal. The notice, if you want to take your case to Federal High Court, you must notify tax appeal tribunal. I've heard your judgment, but I've not satisfied with your judgment. I want to inform you that I want to pursue this case further to the Federal High Court. You must notify them within 30 days after the tax appeal tribunal made their judgments. Hello, are you with me?
Yeah, with
Hello?
you, sir.
Okay. You must notify them. The ground of the law in which the decision of tax appeal tribunal is being challenged. The reason why you want to challenge the decision of tax appeal tribunal, either as a tax authority or as a taxpayer, you must state it if you want to table your case to tax appeal to Federal High Court. So they can be asked, what are the conditions of taking a case to Federal High Court? The amount involved must not less than 400 naira. The appeal must be point of law. It must be on point of law. The notice of appeal must be given to tax appeal tribunal within 30 days after the date of judgment of the tax appeal tribunal. The ground of the law in which the decision of the tax appeal tribunal is being challenged should be stated. After, Federal High Court will invite you again, you taxpayer. They will also invite the tax authority. They will hear the case. Federal High Court will make their judgments. Once they make their judgment, if you are not certified, either as a tax authority or a taxpayer. You also have a right from Federal High Court. You have a right to proceed further. To where? To Court of where? Court of Appeal. You can go to Court of Appeal after Federal High Court. But before you can go to Court of Appeal, what are the conditions? The amount involved must not less than 1,000 naira. Outdated law. The appeal must be on point of law. The notice of appeal against the decision of Federal High Court must be given within 30 days after the judgment of Federal High Court. The ground law on which the decision of Federal High Court is being challenged must be stated. After Court of Appeal made judgment, if you are not certified, you can proceed for where? You can proceed to where? After Court of Appeal, where do you proceed to? Supreme Court. From Supreme Court, you don't have anywhere to go again. No. It to accept and leave the case for who? For God. Do you understand? So, ladies and gentlemen, if they ask you, explain tax assessment procedure, what do you need to state? Where do you need to start? If they ask you assessment procedure, the first assessment procedure will start from where? Who can tell me?
Self-assessment.
Notice of what? Notice of assessment.
Number
From notice of assessment, what is the second procedure?
then notice of
Notice of objection.
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 From notice of objection, what is the third? Notice of
appeal.
amendment or
Amendment.
refusal to what?
Refusal
To amend.
To amend.
From notice of
object.
amendment, what is the next step? The next stage? Notice of appeal. From notice of appeal, what is the next stage? Tax appeal tribunal. From tax appeal tribunal, Federal High Court. From Federal High Court to where? Court of Appeal, Abi. From Court of Appeal to where? Supreme Court. So, ladies and gentlemen, this is all what we need to know on tax assessment. Do we have any question? Do we have any query? I have some questions here. Some of these questions, they are likely exam questions. So please study them. Question 1, question 2, question 3. Study them. I have the solution there. Please study them. In this question, in this area, what you need to know the content of notice of assessment. Content of notice of assessment. Valid ground of objection. You need to know that too. Ground of appeal too. You need to know that. Condition for Federal High Court. You need to know that. Condition for Federal Court of Appeal too. You need to know that. So that is assessment procedure. We have talked about tax assessment. Under the tax assessment, we talk about type of assessment. Who can tell me what type of assessment we have? 4. Name at least 4 type of assessment. We have type of tax assessment. Let me help you. Number 1, self-assessment. Number 1 is what?
Government assessment. Self-assessment.
Number 2, government assessment.
Government assessment.
Number 3, assessment based on what? Turnover.
Based on
We have
turnover.
minimum tax assessment. We also have assessment based on what?
Dividend.
Dividend.
We have provisional assessment. We have additional assessment. But out of those assessments, I'm more particular on self-assessment. What are the benefits of self-assessment? What are the limitations of self-assessment? We need to know that. We need to know that. What are the conditions where company will be assessed based on dividend? We need to know that. However, what are the exemptions to dividend assessment? What are the situations whereby company declare dividend more than actual profit, but they will not pay tax on that dividend declared? Where the dividend is declared from retained earning or reserve. Where the dividend is from tax exempt what? Profit.
Item.
So those are the conditions. So please, let's know that. Minimum tax assessment. Why will a company assess to minimum tax when they make a loss? And the rate of minimum tax is what?
0.5%.
0.5%.
Turnover of your total turnover, less frank investment income. So, ladies and gentlemen, I think I've tried for today. Do we have any question?